So imagine you are standing on the sidewalk of a major city, right? And you're craning your neck all the way back to look up at this brand new billion-dollar skyscraper.
Oh yeah, the massive glass and steel ones.
Exactly. It's this total marvel of engineering gleaming in the sun. But, behind all that glass and steel, there is this massive invisible web of financial risk. I mean, if that building were to, heaven forbid, catch fire, or if a huge catastrophe struck, the financial devastation would be almost unimaginable.
Oh, absolutely catastrophic.
Right. And you would naturally think that the insurance company that wrote the policy on that building must just have, I don't know, vaults of cash sitting around waiting for a disaster.
Like Scrooge McDuck or something.
Yeah, exactly. But, well, the truth is, they actually rely on this massive hidden ecosystem to keep the modern world functioning. So today, using the 004 reinsurance study materials, we are dedicating this deep dive to decoding how this invisible engine actually works. So, okay, let's unpack this.
Quite the engine, too.
It really is. And, if we strip away all the intense financial modeling, the foundational definition is actually wonderfully simple. I mean, reinsurance is quite literally insurance for insurance companies.
Yeah, that's the perfect way to phrase it. It's basically the mechanism that keeps the entire global economy running. Because, when an insurance company takes on more risk than it can comfortably handle, it goes out and buys its own insurance policy to cover a portion of that risk.
So they're hedging their bets, basically.
Exactly. It spreads the potential financial impact so that no single company is left, holding the bag if something catastrophic happens.
Okay, so to really understand how this secret ecosystem operates, we need to, I guess, establish the three main characters in any given scenario here. First, you have the policyholder.
Right, which is you.
Right, that's you listening right now, or maybe the business owner buying the coverage. Then you have the primary insurer, which is, the company you actually buy the policy from, the name on the building.
Yeah, the one you write your premium check to.
Exactly. And finally, you have the reinsurer, the company sitting behind the scenes, providing coverage to the primary insurer.
And while that might sound like just a simple handoff, I mean, the legal and financial mechanics of how those three interact is what actually makes the whole system viable.
Right. Though I have to admit, if I'm putting myself in the shoes of, like, a regular consumer, my first reaction to this is actually a little defensive.
Oh, really? How so?
Well, wait. So if I buy a policy, is my insurance company secretly passing off my risk behind my back? Like, I specifically chose to do business with them, right? I trusted them with my risk, and they just turn around and sell it to some nameless third party.
Yeah, it is completely natural to feel that way. I hear that a lot.
Yeah.
But what's fascinating here is that this isn't a betrayal of trust at all. It is actually a vital mechanism for your own protection.
For my protection, how does them selling my risk protect me?
Well, think about it. If primary insurers didn't offload some of that risk, they wouldn't be financially stable enough to guarantee your claim in a true worst-case scenario. To understand how they do this without, abandoning you, we need to look at how they slice up the responsibility.
Okay, I'm with you.
So in this transaction, the primary insurer, the one who originally wrote your policy, they're called the ceding insurer, or sometimes the cedent. They are ceding or transferring a portion of the risk.
Okay, so the primary company is the ceding insurer. But they don't give away all the risk, right? I mean, because if they just pass the whole thing off, why are they even in the business to begin with?
Right. They absolutely do not pass it all off. The actual portion of the risk they transfer over to the reinsurer is called the cession.
The cession, okay.
But crucially, the primary insurer always keeps some skin in the game. The amount of risk that they decide to hold on to for themselves, that's called their retention.
Ceding insurer, cession, and retention.
Yep.
Okay. It is almost like they are baking a pie, right? And they keep a slice for themselves, that's the retention, and they pass the rest of the pie, the cession over to the reinsurer.
That is a great analogy. Yeah, exactly.
But this brings up a bigger question of scale for me. I mean, we know what it is now, but why is it so strictly necessary on a global level? Because insurance companies collect billions in premiums. If they have massive pools of capital already, why do they need to offload risk at all?
Yeah, that's the billion-dollar question. To really get to the bottom of that, we have to look at the functional mechanics of the industry, starting with Underwriting capacity.
Underwriting capacity.
Right. Without reinsurance, human progress basically halts
Oh.
because insurers simply could not accept massive, unusual risks. I mean, think about an oil refinery or a massive international airport or a professional sports stadium.
Oh, because the potential loss on like an oil refinery is so astronomical that a single primary insurer would face instant bankruptcy if it exploded.
Precisely. Their internal capital limits would literally force them to say no to insuring that project. And if a developer can't get insurance, well, a bank will not give them the loan to build it.
No insurance, no loan, no building.
Exactly. So reinsurance gives primary insurers the artificial capacity to say yes to those massive projects by allowing them to spread the exposure instantly.
Okay, so underwriting capacity makes total sense. It means they can actually build the skyscraper. But what about the day-to-day stuff? If a hurricane wipes out a dozen of these skyscrapers on the coast, how does the reinsurer taking a hit affect me, the average person buying a home insurance policy thousands of miles away?
So that links directly to the pricing mechanism. Reinsurance creates this deeply interconnected global web of capital. If a massive catastrophe happens, say, a historic cluster of severe hurricanes in Florida, reinsurers take a massive financial hit.
Right, they have to pay out billions.
Yeah. And because their global capital pool shrinks, the cost of buying reinsurance goes up everywhere. When reinsurance gets more expensive, primary insurers everywhere have to pay more for it. And what do? They pass those operational costs down by raising regular insurance premiums for their policyholders.
Even if those policyholders live in a totally different region.
Even if they live in a totally different region, yes.
Wow. So a catastrophic tsunami in Japan or like a massive wildfire in California can literally shift the pricing of a commercial warehouse policy in Ohio. The risk is completely globalized.
It is entirely globalized,
Yeah.
which honestly is the only way to survive the third major factor here, catastrophic claims. Reinsurance is ultimately about sharing the burden of highly concentrated losses.
Concentrated losses, meaning too much risk in one spot.
Right. If one primary insurer happened to write all the homeowner policies in a specific coastal town and a Category 5 hurricane flattened that town, the sheer volume of simultaneous claims would destroy that company overnight.
But by using a reinsurer, that local destruction is subsidized by a global pool of money.
Yes. Reinsurance distributes that concentrated loss across a much wider network. It ensures that there's enough capital pooled together to actually rebuild the town without bankrupting the primary carrier. It smooths out the financial volatility. From a risk management perspective, it ensures an insurer's balance sheet doesn't look like a terrifying roller coaster from year to year.
It kind of feels like splitting a massive, ridiculously expensive dinner bill with a large group of friends.
Oh, I like that.
Yeah, like imagine you go out to a fancy restaurant, right? And someone orders the most expensive steak on the menu, a few bottles of vintage wine, and suddenly the bill is astronomical.
And if one single person at the table had to pull out their wallet and pay that entire bill, they might literally miss their rent that month.
Exactly. So the primary insurer offers to take the reservation and put their credit card down at the end of the night to settle with the restaurant. But behind the scenes, all the friends, the reinsurers are, Venmoing them their share of the risk. Everyone pays a manageable fraction, the restaurant gets paid in full, and no single person gets financially ruined.
That is a perfect way to conceptualize it.
Yeah.
The restaurant, the policyholder only deals with the person handing over the credit card. The back-end peer-to-peer transfers are completely invisible to them.
Right. Okay, let's move from the restaurant to some real-world practice. I want to see this financial pie splitting in action using some real numbers. Let's use a commercial property example from the study material.
Sure, let's walk through it. So imagine an insurance company agrees to insure a brand new shopping mall, and the total value of this property is $500 million.
$500 million. Wow. That is a terrifying amount of concentrated risk for one company to hold on one geographic location.
It really is. So the primary insurer's actuaries look at their financials and decide, okay, we are only mathematically comfortable keeping $50 million of this risk on our own books.
And that $50 million is their retention.
Right. That's their retention. But the mall is worth $500 million. So they take the remaining $450 million of risk cession and they transfer it to several different reinsurers.
And what happens mechanically if the absolute worst happens, like a massive tornado tears through the town and completely levels this $500 million shopping mall? Who actually writes the check?
So the primary insurer steps up and pays the policyholder, the mall owner, the full $500 billion claim right up front, allowing them to start clearing the rubble and rebuilding.
Okay, so the mall owner's happy.
Exactly.
Okay.
Then, behind the scenes, the primary insurer submits their own claim to the reinsurers, who reimburse the primary company for their $450 million share, exactly as dictated by their agreements.
So the primary insurer only ultimately absorbs the $50 million they originally retained.
You got it.
But wait, how does the primary insurer actually buy this reinsurance on a logistical level? I mean, do they have to pick up the phone, send over blueprints, and negotiate a brand new contract every single time a client buys a mall or a warehouse or a fleet of delivery vans? Because that seems wildly inefficient.
It would be. It would bring the entire industry to a grinding halt. Because of that, the industry has developed two very distinct methods for purchasing this coverage. The first is called treaty reinsurance, which is built specifically for efficiency.
Treaty reinsurance. Sounds like a formal pact between nations or something.
Yeah, but think of it more like an automatic subscription model for risk transfer. The primary insurer and the reinsurer sign a treaty that provides automatic coverage for a whole predefined portfolio of policies.
How does that work in practice?
Well, for example, the treaty might dictate, we will automatically reinsure 50% of every single commercial property policy you write this year that is valued between $10 million and $50 million, as long as it's not located in a flood zone.
Ah, I see. So as long as the primary underwriter writes a new policy that fits neatly into that predefined box, the reinsurance attaches instantly. No phone calls, no individual negotiations, it just ships.
Exactly. It is highly efficient, high volume, and handles standard, predictable risks.
Yeah.
But, as you pointed out earlier, what happens when a risk doesn't fit neatly into the box?
Right. What about that billion-dollar skyscraper or, I don't know, an experimental offshore wind farm? You can't just auto-subscribe a wind farm.
No, you definitely can't. For those highly unique or massive risks, you use the second method, facultative reinsurance. This is negotiated individually for one specific, isolated risk. It is a one-off, custom-tailored deal.
So the reinsurer actually wants to look at the specific blueprints of that single skyscraper, understand its exact fire suppression systems, look at the local crime rates, and then price the risk for that building alone.
Yes, the reinsurer acts as a secondary underwriter for that specific property. The primary insurer offers the risk to the reinsurer, and the reinsurer has the faculty or the option to accept or reject it.
I imagine that takes a lot longer.
Oh, it is far more time-consuming and labor-intensive, but it is entirely necessary for massive, highly concentrated risks that a standard treaty simply wasn't built to absorb.
Okay, so treaty is the bulk, automatic subscription for the standard stuff, and facultative is the custom, bespoke, hand-tailored suit for a specific massive risk. That makes perfect sense.
Exactly.
Now, since a lot of our listeners are studying for their CPCU exams, let's talk about where people fundamentally misunderstand this, because I know even industry veterans sometimes get the legal realities twisted when they're dealing with these complex structures. What is the biggest misconception out there?
Well, the most dangerous misconception, and a classic trap on exams, is fundamentally misunderstanding who this ecosystem actually serves. People will often confidently state that reinsurance protects the policyholder.
Which, I mean, feels intuitively true, right? Because without it, the primary insurer goes bankrupt and I don't get my claim paid. So it is protecting me in a way.
It provides an indirect benefit to you, absolutely. But legally and functionally, that statement is false. Reinsurance does not protect the policyholder. It strictly protects the insurance company.
Just the company.
Yes. Its sole purpose is to protect the insurer's balance sheet and financial stability. By keeping the insurer solvent, it indirectly ensures you get paid, but if you are asked on a test or in a boardroom who reinsurance protects, the answer is always the insurer.
That is a crucial distinction. Indirect benefit versus direct protection. But, you know, that leads to the second major point of confusion for me. Let's go back to that $500 million mall.
Okay, the mall.
Let's say it burns down. But in a shocking twist, my primary insurance company goes completely bankrupt the next day. They have no money. Do I, as the mall owner, just bypass them and sue the reinsurer directly to get my $450 million? I mean, they were technically holding the risk, right?
That is the second trap, and the answer is a hard no. You cannot sue the reinsurer because you have absolutely no privity of contract with them.
Gravity.
Yeah, privity of contract. It means the legal contract exists only between the ceding insurer and the reinsurer. You, the policyholder, are completely outside of that agreement. The reinsurer made a promise to the primary company, not to you.
So they literally don't owe me anything.
Right. Therefore, you have no legal standing to demand payment from them directly.
Wait, so if the primary company goes bankrupt, the reinsurer just gets off scot-free, they get to keep the premiums and pay nothing?
Well, not exactly. The reinsurer still owes the money, but they owe it to the primary insurer's bankruptcy estate, or, the state liquidator who takes over.
Oh, I see.
Yeah, the liquidator collects that reinsurance money and adds it to a general pot to pay off all the primary insurer's creditors, of which you are just one. You don't get a direct pipeline to that specific reinsurance payout.
So what does this all mean? It means the original insurer remains 100% responsible to the policyholder, period. The policyholder only ever deals with and looks to the primary company whose logo is on their policy.
That is the ultimate rule. If a reinsurer goes bankrupt and can't pay their share of the cession, too bad for the primary insurer. They still owe the policyholder the full $500 million.
Okay, to really cement all these technical dynamics into long-term memory, I was trying to think of a physical visualization for this. It feels a lot like climbing a mountain.
A mountain climber analogy works beautifully here, actually.
Yeah.
Yeah. Imagine a climber scaling a sheer cliff face. In this scenario, the primary insurer is the mountain climber. They are the ones out there doing the heavy lifting, interacting with the rock, making the strategic moves, and, taking on the direct challenge of the ascent. They are the face of the operation.
And the reinsurer is the safety rope.
Exactly. The climber's doing the work. But if they slip, if a catastrophic loss happens, that safety rope catches them. The rope absorbs the massive lethal impact of the fall. The climber might still get a few scrapes, bang their knee against the rock.
Which is their retention, right, the financial hit they agreed to take.
Exactly, that's their retention. But the rope prevents them from plummeting to total destruction.
The insurer still scales the mountain and pays the claim, but the reinsurer absorbs the fatal financial blow. I love that. But let's look at the bigger picture here, because this isn't just about saving one climber from a fall. How does this safety rope appease the regulators watching the whole mountain?
Well, if we connect this to the bigger picture, this brings us to a critical financial mechanism called risk-based capital, or RBC, and the concept of surplus relief.
Okay, risk-based capital.
Right. Regulators, like the state insurance commissioners, act as the park rangers on this mountain. They demand that every insurer maintains a strong capital position, basically a healthy ratio of surplus cash compared to the risks they've written.
Okay, so let's put some simplified numbers to this. Say a primary insurer has $100 million in assets, but they have taken on so many policies that their potential liabilities, the claims they might have to pay, are sitting at $90 million.
In that scenario, their surplus is only $10 million. That margin is dangerously thin. The regulators look at that ratio and say, you are carrying too much weight. You need to either raise more cash immediately or stop writing new policies entirely.
Which means the company stops growing. They're paralyzed.
Right. But if that primary insurer takes $50 million of those liabilities and cedes them to a reinsurer, their liabilities suddenly drop from $90 million down to $40 million. Their assets remain strong, but their potential obligations have been slashed.
Oh, wow. So suddenly their surplus ratio looks incredibly healthy.
Exactly. That mechanism is called surplus relief. By transferring a large chunk of their risk, the primary insurer instantly improves their risk-based capital ratio.
So they can keep doing business.
Yeah, it frees up their balance sheet, satisfies the strict regulatory demands, and allows them to continue growing and writing new business safely without having to go out and, raise new equity.
That is fascinating. It's essentially a financial pressure release valve for their balance sheet. But as I was reviewing the mechanics of all this risk transfer, I started thinking about risk aggregation. I mean, if all these primary carriers are passing their risk up to a handful of massive global reinsurers, don't the reinsurers eventually become dangerously overexposed themselves?
Oh, they absolutely do. And that realization is what drives the final, most mind-bending layer of this ecosystem: retrocession.
Retrocession. It feels like a glitch in the matrix. It is literally a reinsurer buying reinsurance from another reinsurer.
It really is layers upon layers of risk transfer. Let's say a major global reinsurer signs treaties with 20 different primary insurers who all write property coverage in Florida. Everything is fine until their actuaries run the models and realize, uh-oh, if a Category 5 hurricane hits Miami, we are going to get hit with maximum claims from all 20 of those treaties simultaneously. We're holding too much concentrated risk.
They realize their own safety rope is about to snap.
Precisely. So to offload some of that aggregated risk, the The reinsurer goes out and buys their own reinsurance policy from a completely different reinsurance company, perhaps one based in Europe or Bermuda.
And that's retrocession.
Yes. That specific transaction, a reinsurer ceding risk to another reinsurer, is called a retrocession.
It's just slicing and dicing the risk and trading it higher and higher up the chain, which is incredible, but also slightly dizzying when you really think about it. But before we get too lost in the financial matrix, let's bring it back down to earth and recap the core takeaways for everyone's study guides and professional knowledge.
Yeah, let's synthesize the main points. Fundamentally, reinsurance achieves three critical things for the industry. First, it increases underwriting capacity, allowing primary insurers to say yes to massive risks like skyscrapers and stadiums.
Second, it stabilizes financial results by pooling global capital to smooth out the devastating volatility of local catastrophic events.
And third, it protects the insurer's surplus, providing that vital surplus relief to drop liabilities and meet strict regulatory risk-based capital requirements.
And if you are going to remember just one golden rule from this entire deep dive, whether you are sitting for a CPCU exam tomorrow or just trying to understand how the financial world operates, it is this. Insurance protects people. Reinsurance protects insurers.
Yes, insurance protects people. Reinsurance protects insurers. If you understand the legal realities of that sentence, you understand the core of the industry.
It is the perfect distillation of everything we've explored today. But as we wrap up, I want to leave you with a final thought to roll over, especially as we consider things like the 2008 financial crisis or the sheer scale of modern global interconnectedness. We've built this entire logical structure here. The primary insurers pass off their catastrophic risk to the reinsurers so they don't go bankrupt. And then through retrocession, those reinsurers pass off their concentrated risk to other reinsurers and so on.
The web of risk transfer expands indefinitely across the globe.
Exactly. But if everyone is constantly passing the risk to someone else, how far up the chain does this actually go? Does the risk ever truly disappear? Or is this just being sliced and diced and traded so many times that the entire global financial system is secretly holding the bag together? I mean, if one massive, truly unimaginable, world-altering catastrophe were to happen, something that hits the entire globe simultaneously, who is the final safety rope at the very top of the mountain, it makes you look at those billion-dollar skyscrapers just a little bit differently, doesn't it? Something to think about the next time you look up at the skyline. Keep studying, keep questioning, and we will catch you on the next deep dive.